Hello, everyone, and welcome to Merk's Gold Miners webinar, Bargains or Peaking Out. My name is Darshan, and today on the call we have Axel Merk, President and CEO of Merk Investment, and portfolio managers Peter Melitis and James Holman. Like always, we are going to start the webinar with some slides and Axel's view on the markets. Just like our previous webinars, we will have the Q&A session at the end. So please feel free to drop questions in the Q&A box during the webinar. And also note that this webinar is recorded. With that, I'll pass it on to you, Axel.
Thank you, Darshan, and welcome everybody. And at first, I'll give you this wonderful disclosure to read. As Darshan pointed out, I'll start out giving you a little bit of an overview of where I see the markets, notably the gold market. Then I'll hand it over to Peter and Jamie to discuss the gold mining sector a little bit more. And then we talk a little bit more specifically what we do at ASA, the closed-end fund that we manage. One of the things, as I go here to the first slide, is we send out the monthly chart book. I believe most people joining are on the mailing list and receive that. This is one of the charts that show how the NYSE Arca Gold Miners Index, that's the underlying index to GDX, relates to the S&P 500, and now it's coming a little bit to live, but at least based on this historic basis, an argument can be made that that relative to the S&P, maybe there are ways to go. And part of the goal of today's webinar is to give you an idea of where we are in the cycle for the gold miners in particular, and whether this fairly amazing rally we've had, whether that is more of a sign of a peak or more of things that might still come. Before we go into that, though, let me give you a broad overview. And I have commented on these things in various podcasts that I've given and the like. But I just want to give you a context, and this is mostly applying to the price of gold, but obviously implications for gold miners as well. Not telling anybody any secret that the Max 7s have done well. Many of you have heard that there's increasing off-balance sheet financing for these AI projects, which is a sign that maybe the equity market's overvalued. And the context here is that investors are looking for diversification. Um, People are concerned about bonds for a variety of reasons, in particular because of the lack of fiscal discipline that seems to be deeply rooted in both parties, with no entitlement reform. And people always like to put a macro story onto what's happening in the bond market, but an increasing number of people are thinking that bonds aren't the safe haven they used to be. And the volatility in gold and gold miners has obviously shown that gold isn't the perfect substitute to bonds. But still, as people are looking beyond bonds, gold is a beneficiary. And because the gold market is just so much smaller than the bond market, you can see outsized returns. Geopolitics, I have said in various ways that I don't like it when the price of gold goes up because there's a crisis somewhere, because many often the bump in the price of gold is short term. We see that often in gold miners not getting a bid. That said, what we've seen or what we are seeing unfolding is really a more structural shift where the world is less safe. The peaceful period since World War II is coming to an end. And in my assessment, what we've seen in Gaza or Ukraine are just symptoms of a new era. And if nothing else, it means that there's a lot more spending on defense that's happening. And then I do want to point to climate change as well. And this is really no matter where you are in that debate. If you believe government is going to do a whole bunch of things to quote, unquote, protect us against climate change, that's going to be expensive. But if you believe government is going to have a hands-off approach, that's also going to be expensive. The money might be spent differently, but there will be the world we are in, and especially with entitlement reform and aging baby boomers, means that a lot of money is being spent. The UK just is announcing another round of tax hikes, and so not everything is going to be done with deficit spending. But that's the context we're in. And then one thing, and I haven't heard many others talk about it, but I keep coming back to this because I do think it's a key to understanding what's happening in gold and the bond market is that tariffs don't just disrupt the flow of goods. There is the other side of that, which is the flow of currency. And when you disrupt the flow of goods, you're disrupting the engine that we call the exorbitant privilege. You're not destroying it, but you put sand into that machinery, which leads to higher borrowing costs in the US, which means deficits need to be financed more domestically. And with that comes more pressure on the Federal Reserve. And the other part that's part of that tariff package is more nationalist policies. And we don't just have that in the US, we have that around the world that's on the increase. And let me just kind of abstractly call these things inefficiencies. When you don't have the free market allocate money, you're going to have less efficient outcome. Now, you may argue for national security reasons that's all good and warranted, but it's still less efficient, more expensive. Those sort of drivers help the precious metals market. And so I just want to give that as a backdrop as we go here into the discussion. And I'm handing it over to one of you, Peter or Jamie, to kind of cover the next few slides here.
Yeah, it's over to me. Welcome, everybody. Yeah, so this slide demonstrates the decline in prevalence of the energy and materials sector as a percentage of the overall market. This slide was presented by Tabby Costa, a friend of Peter and I's, who we thought put out some interesting information there, and it just shows the decline in prevalence of the industrial sector. I think that this dovetails with Jeff Curry, from former Goldman Sachs analyst, and now he works at Carlyle, has this idea of the revenge of the old economy. And effectively, when you've had such huge allocation of resources, money, go into the technology sector, it has starved the old economies. And one of the old economies is the energy and materials sector. Um, and so that has led to supply tightness, and it's been, and those have been exacerbated by, um, uh, you know, the, I would say the flow to high tech and the focus on ESG has exacerbated the demand for some of these commodities. Yet at the same time, you're starving these commodities by not giving the producers of the commodities ample capital to then grow their supply base. And so we've started to see, a forecast of shortness in some of these commodities going forward as we forecast supply and demand. And then, I guess the question would be that, we've seen obviously the gold and silver market do very well, but then some of the other commodity markets have been more anemic. And I think that that has probably been a result of what we've seen within, the Chinese economy, which was a driver of the old economy, and they have been suffering since the COVID shock. I think we saw, their housing market rollover. And in between 2024 to the present, I think that there's been this structural downturn that's been, driven by the consumers within China taking a more conservative approach to the world as their major assets, that being their real estate, has collapsed in price, and therefore saving more, which has strapped their economy. That has led to, the CCP doubling down on the industrial economy, manufacturing cars, batteries through subsidies, which has led to overcapacity. And so one thing that they have been doing is exporting deflation to us, and they have not been consuming as many commodities that they have in the past, which is interesting because that hits us at a time where, we have been also struggling with inflation. So we've been benefiting from the deflationary influx from China. And then I think what we should look out for going forward is what the rate of change of that deflation is. And I think that we are getting near a tipping point, and especially will be exacerbated by tariffs as we go forward, that I don't think that we will be getting that deflationary tailwind from China. And then the other element that I would talk about is, the K-shaped economy within the U.S. and how that has put pressure on the low end of the low income portion of our economy, which has a higher propensity to spend on goods that are commodity driven. And I think that, as Axel alluded to, I think that that will lead toward more socialist policy, which will ultimately put us back into a cycle of where we will see probably more handouts like we saw during COVID. Yeah, so ultimately, given that outlook, I do think that we'll see more capital flowing back into the material sector, and it's going to be required by, the need for um, uh, critical materials that, feed the economy. And yeah, I think that that's a structural shift that we'll see over the coming years, will be capital flowing into that sector. Yeah, here's, the S&P 500 historical weightings from 1990 to the present. This kind of demonstrates what we saw on the other chart. Similarly, the materials section has gotten squeezed and the technology sector has gotten significantly larger, along with healthcare. Healthcare alludes to, the aging of our economy and the inflation that we've seen within that sector. Um, this is, I guess, overall, it's a trend that, if you look back through history, you would expect to see. If you went to the dawn of the Industrial Revolution, you would expect that that the coal industry would be large, and that was the most prominent industry of the time, and that would shrink over time. And, we've got the increase in the technology industry and everything that's come out of that. But I think that generally, it's gotten very out of whack in where the global economy is allocating capital and has definitely starved the material sector of the necessary capital. Let's go to the next slide. This is just showing the same thing again. It's showing gold and gold miners. Well, this is specifically gold and gold miners as a percentage of global assets, and significant lows. There's a lot of room for this to bounce back. I would say that most large asset managers in the US don't have any allocation to the gold and gold miners. Certainly not gold miners, maybe gold. So I think that there's a lot of room to grow on this. In a small allocation, 1%, 2% allocations can have a dramatic effect in the overall allocation of the gold miners. So we see that there's a lot of room just in the mobility of capital for the sector. Yeah, going over the bear markets and bull markets that you see in front of you. Yeah, so this kind of just gives a historical context of where we are. Yeah, if you go back to, the just to give context, the first gold market was the monetary system collapse, which destroyed the Bretton Woods system, and then it also had the 1973 oil crisis. And then, 76 through 80 was, we had a significant stagflation, the Iranian Revolution, and then we had the second oil shock in 1979. Um, and then the drop after that was driven by, the Volcker shock of the 1980s. We had high real interest rates through a lot of the 80s and 90s. There was the whole idea of the great moderation and the strong dollar. And then one of the big things that we saw during that time period from kind of the 80s through 1999 was that central banks across the globe were sellers of gold. And there was this narrative of why would you want gold on your balance sheet if you're a central banker? And so that weighed on the price. And then we turned the corner with the dot-com collapse, and we went on a decade-long bull market. And then it kind of was a crescendo with the 2008 crisis, where we saw the implementation of quantitative easing and zero interest rate policy, which really was really a first and a change in a change in how central banks act and how the government acts in response to crises. And since then, obviously, we've gone through a dramatic bear market where we saw gold pull back 40%. And we've bottomed out, and what's really kind of led to the new bull market was really the beginning of COVID, where we saw strong inflation, we saw extremely loose fiscal policy and monetary policy, and then I think that as Axel was alluding to, there's just a stronger and stronger narrative that the debt that a lot of countries hold around the world, and especially within the U.S., are becoming, more and more prominent, and maybe the day of reckoning is coming. So uh, yeah, let's go to the next slide. Uh, Here's an overview of the different bull markets, just to give an idea of where we are in the current bull market. So it looks like we're, whatever this is, like 800 days into this current bull market. And yeah, it was kind of trending along with some of the other bull markets. And then when we saw this move from $3,500 gold to $4,000 gold, it certainly started to outperform. It's kind of given some of that back. Um, but if we could have a similar bull market to what we saw from the dot-com collapse to 2008, obviously there's a long ways to go here. And here's an illustration of some of the bear markets. And yeah, the bear markets can definitely be nasty in the sector. And I think that the slide here it demonstrates that. So it's some significant drawdowns there. I've spoken about those in the other slides. Yeah, so where are we currently? So here's a view of the XAU index. And we do see extreme drops in the equities of the gold miners. And but luckily that is balanced out in this sector by dramatic increases, like we just saw in since this summer. We've given back a good amount on that, and it looks like we're kind of in a standard correction. This is just to give an idea of what a correction could look like. So a median correction, in a cycle like this is down 17%. A three standard deviation, you're looking down 40%. And, we've kind of had a standard deviation correction here along those lines. So, yeah, am I going to call a bottom or say that we're done here? It's a fool's errand to kind of be a short-term trader in this market. Structurally, we think that, we like the market. Yeah, so I think that gives a good context of if you're trying to manage risk in this sector. Um, the positive thing that we have for the sector is that the ETF equity flows into the sector, have not been that strong. They've been strong within the gold sector. So the gold ETF and the gold ETFs throughout the sector have seen, very strong inflows, but the equity ETFs, and as we know that I think it's over 50% of the market now is dominated by, passive ETFs. But in this sector, we've continued to see outflows. So we think that there is certainly an opportunity for the equities to see inflows from the ETF sector, and that would certainly be a tailwind. And then also, just looking at the gold ETFs, we did see, with this drawdown, a slight outflow in the last couple of months, but pretty minor. Yeah, so let's
Let,
head
let
on
me
to the
just
next.
chime in on this one just a tad more. First on the miners maybe, and we'll get into that a little bit more. The big gold ETFs have a very different composition what we have in ASA, and maybe Peter and Jamie, you guys can touch on some of the challenges that they have historically faced, some of them they're overcoming, which might be a contributing factor, but clearly gold miners have not been fully embraced by investors. And on the physical gold side, one thing that's not clear on this chart is we have not reached the all-time high in ounces held in these gold ETFs. We are significantly off those tops, so that's one thing to think about. The other one that's not on this chart, and that's mostly anecdotal, on the coin market, the physical coin market for retail, there has not been quote unquote panic buying as this rally happened. Indeed, one of the things we have seen is that wholesalers are barely selling anything because the coin dealers that deal with retail are getting plenty of gold back into inventory. So they're not ordering from wholesalers to get coins from the mint. And to me, that is not exactly consistent with a top in the market. Sorry, I interrupted you. Back to you.
All right. Yeah, here's an overview of the gold producers and the cost structure. So now we're dropping into kind of the microeconomics of the gold miners. And this is a little bit of a complicated slide, but essentially what you're seeing is in the left slide, left histogram, you're seeing the gold price is the line on the top. And then I think what you want to pay attention to is the length of the solid bars, which is essentially all the costs associated with the gold miners. And as you look at this, you can see that the cost are correlated with the price. But what we've seen since kind of the inception of this bull market in earnest in 2022, that costs have stayed relatively more contained as the gold price has taken off, and you've seen that those margins have significantly opened. And the one thing, just sort of simple math, if you have $1,500 gold and a $2,000 gold price, you have a 25% margin. If you then go to $4,000, you are going to see you're going to see the price go up probably, you're going to see it go up tw 25% of the gold price. So as the gold price doubles, you're going to see the cost structure go from like 1,500 to 2,000. And the reason is that you have royalties and taxation that are connected to the gold price, but you also have we don't like it, but there's definitely just costs that come into the business with a higher gold price. So we kind of think that for every $100 that we see the gold price go up, that the costs are probably going to go up about $25. But that being said, that the change in margin times the change in revenue, is leads to your change in cash flow. So we have a two-time margin expansion and two times revenue is correlating to 4x in cash flow. So that is kind of the backdrop of the operating leverage of the gold miners right now. And I think you can see it in that right chart. It's very significant.
And maybe to add to that, this is substantially more favorable than in recent previous bull markets, where when you had the price of gold go higher, the cost of energy would skyrocket as well. We don't have that this time around. The cost of labor would skyrocket. We don't have that as much. And we haven't seen, although that may still come, governments demand higher taxes and the like. And so for the time being anyway, the margins are expanding much, much better with the rising price of gold than they have in recent decades.
Yeah, I think that is important. Yeah, because and the other thing is that, and I've talked about this in prior webinars, is that when we had the bull market kind of out of the 2008 crisis to 2011, costs just went through the roof, and we saw the discipline of the management teams was horrendous. I mean, they made acquisitions that they had vastly negative returns. Um, and there was also a greater commodity bull market going on at the time with, iron ore and copper and oil and every other commodities. It currently we're kind of in a bit of a Goldilocks for gold because we're not seeing that in the other commodities. I mean, we have oil, which has, been relatively stable, 50, $60, which is, in inflation adjusted terms is a very low price. Yeah, and you do see some inflation within the labor, but it's nothing like it was during the COVID times. I mean, the COVID bump we saw in 2020 and then the disastrous sell-off after that was all inflation driven. And yeah, so it is a nice setup for the market. And as we've watched earnings come through, we have certainly seen cash flows reflect this story. So I'm going to pass it over to Peter, and Peter's going to speak more specifically about some of the stuff.
Yeah, thanks. This slide just kind of further shows the increase in cash flow generated by the margin expansion we've seen. Um, uh, you know, Cash flow generation was relatively limited, and you can see that even through the estimates through the end of 2026, idea of cash flow generated by this is the RBC producer coverage list, so it's the large caps and some of the mid caps, up to potentially $16 billion by the end on a quarterly basis by the end of 2026, and then on a free cash flow basis, it's CapEx spend will be increasing, but at the end of the day, the cash flow generation in terms of free cash flow continues to expand rapidly. There's very little debt service required here, and the one thing about the labor, as Jamie kind of said, is in prior commodity cycles, the gold companies were competing with other commodities like iron ore in particular for labor, but we're not seeing the gold market has increased at a much faster rate, and so that's where you're seeing the competition. But the bulk commodities are definitely sort of stable right now. So next slide.
The other thing to mention maybe is that you mentioned that there's very little debt. The large producers have taken down debt, which actually gives them less leverage to the price of gold, whereas on the more junior space, you have much more leverage to the price of gold.
Yeah.
At least
So
that's
this
how I
slide right
assess it.
here shows that.
There we go. There we go.
Trying
Go
to
ahead.
step all over me.
I'm just gonna take your thunder here.
Yeah,
Go
and
ahead.
this is kind of what Jamie alluded to is that in the 2010 to 2016 timeframe, a lot of the companies levered up to acquire other companies, and this is what kind of took down the market is the growth companies over levered, and then the gold price came down, and so they had to delever and focus on cost. They weren't worried about cost at the time for the last, since about 2017 to now, we've had a, flattish to up gold price in the last couple of years, and the cash flow generated has made all these companies net debt, negative, and so the balance sheet is not a concern, not even close to a concern, and the cash flow is increasing at such a rate that they can do growth, but they've started significant share buybacks and dividend increases. So on a dividend yield basis, a lot of these companies are trading at levels that are comparable, if not greater, than most of the other sectors within S&P 500, for example. And so we're very, they can still layer on some debt if they wanted to, but they really can use their cash as a main driver of acquisition rather than uh, debt levels. And then here it just shows the valuations. In prior cycles, a 2 times NAV was kind of a historic level. Axel kind of talked about the idea that without the debt, the leverage to the gold price has decreased. So you should see a decrease in a price to NAV multiple, but it's really at all-time lows. We haven't seen the type of growth in the gold price that we have seen in the last year and a half. As Jamie said, the margin expansion is a multiple of what it would have been because costs aren't rising at that level. And so, a price to NAV basis, a lot of these companies are still dropping because the margin expansion is so significant that NAV is accreting at a level that we're not used to. So we do believe that in this case that multiple expansion still is possible, and a lot of these companies still haven't benefited from that. And then here just shows kind of for specifically to, on a RBC estimates relative to the market. We're getting to a point where spot estimates are lower than consensus. And on a price to cash flow and EV to EBITDA, these are metrics that historically we haven't looked at as closely as other sectors, but when you compare it to a lot of these other sectors now, you can look at these price to cash flow and EV to EBITDA, and they're trading at historic lows, which should get a generalist investor to kind of enter the market when they compare it to the other sectors that we're looking at. I will say that a lot of these companies that are used in these estimates by RBC are the large caps, which we kind of figure aren't growing at a significant level. They are generating a lot of cash, but they don't have the growth aspects that we're looking for. So we're looking for names that will grow within the gold market. They're not relying specifically on the gold price for equity appreciation. We've talked about that a lot in numerous webinars we've been participating in. But the large caps are essentially proxies for the gold price and the miners. There'll be some leverage to the gold, but what we're really looking for is that sort of extra amplification with growth and gold's price appreciation. And a lot of the names that we've purchased or are entering are those types of companies where we can see multiple expansion fairly quickly.
There we go. Peter already gave a little introduction as to what we do. Let's talk about the closed-end fund we manage, ASA Gold and Precious Metals. And as of yesterday, and for those who listen to a recording, that was Wednesday, the 12th. Yeah, we had just over $1 billion in net assets, and as a closed-end fund, which does not have daily creations and redemptions, inflows and outflows, had a discount, a market price discount of 9%. And just to put that into context, when Peter started managing this fund in April 2019, it had 230 million. And so we have been able to grow this fund to around $1 billion now, net of dividends and net of some share buybacks that have been in the market. And that has not been a straight line. It's been a very volatile period over the period, and we'll go into some detail here in a minute. But as Peter's pointed out, we focus more on the smaller end of the companies, the junior companies that have company-specific catalysts. And unlike open-end product like an ETF or a mutual fund, we don't have these daily liquidity requirements, which really allows us to also invest in companies that are much less liquid than what you typically see in an ETF.
And also, and one other thing to add is it gives us the ability to be patient with our investments. So we can take positions and just focus on the fundamentals and not have to worry about the machinations of the market. And so a lot of the names that are at the top of the portfolio have been names that we've been in for a number of years, and we find teams and assets that we really like, and we let those positions grow in a way that without having to deal with the inflows and outflows that a typical mutual fund has.
Yeah, and if one way to think about it, you have a liquid wrapper to a somewhat less liquid or illiquid investments. And so having a bit of a market discount is quite natural in that, because you could technically sell it any day. But you're really providing access to something that is very, very difficult in our assessment to access otherwise. And then, of course, and this is really a traditional bottom-up investment. And these are not things that you trade in and out. I think if anybody who has been investing in this market probably has realized that timing, especially the mining side, is extremely difficult. There are plenty of people that try to time the price of gold, and if you can do that, great. But we've seen in recent weeks 5% moves in a day, over 10% moves in a week. And if you miss that, it's you're missing out on a great deal. And so ASA, the way we manage it, tends to have a much more patient approach and riding out some of these waves. By the way, the levered ETFs that are in this space, they're bound to lose money, because if you lose 10% and gain 10%, you're not back up to 100%. And obviously that's a huge challenge when the volatility is great. Let me give you some performance metrics just so that you can have a look. Just before the call, I was asked, why do we have this as of September 30th and not of October 31st? Because it would look more favorable. One thing about October that is noteworthy is that the sector experienced very high volatility. From what we have seen based on the peers, and I'll show you the peers we look at here in a moment, we were the only fund that was actually up for the month of October. Everybody else suffering during that month. And so so maybe we should have included October. But the numbers are, are pretty good no matter how you look at them. The cumulative returns since April 2019. The We list the NYSE Arca Gold Miners Index. That's basically GDX, the underlying index, and then we list that separately. And then we use a gold index rather than price of gold. The difference is that best industry standard is to use something that actually um, has an income component to it, and so this is a collateralized gold futures. The price of gold itself is very, very similar. This is the same chart, just showing the outperformance. By the way, you can have a copy of these slides if you drop a message. And then quite relevant, I would think, is that to look at it in the context of risk. And there are, of course, different ways of looking at risk. Here we look at the analyzed return since 2019 divided by the standard deviation. And the price of gold is obviously less volatile and has had a very good run. And so that has a better risk-adjusted return. But compared to the benchmarks and the major indices, ASA has had a very favorable performance. And there's another way to look at analyzed risk in separate bars. And similarly, the risk of the gold miners in ETF is actually higher than the ETF is lower, but the juniors is higher. And the junior gold mining ETF is actually larger companies on average than we do. The junior gold miners ETF is not all that junior.
Yeah,
And
one thing I
here,
might comment on that, Axel, is just that these are the quantitative metrics of risks that are used in quantitative finance, but I think really the risk of the portfolio is managed at the company level in the security selection and the characteristics specifically of the companies. And the majority of our, the companies that we've owned them actually since extremely low valuations and are aligning ourselves with management teams that have a track record of exceptional execution. And, also these companies are, have limited debt as well, which, makes for what we see as a fundamental risks are low in these companies.
yeah, and I think one of the things you guys say, rightfully so, is the scarcest resource in this sector is good management. Being
Yeah.
able to execute is a skill that not many have. In a bull market we have right now, a lot of projects get funded, but not many projects can execute. And one of the things to keep in mind is that we have a closed pool of capital, so we
Yeah.
need to reallocate capital. And while we like to let the winners run, they are the most obvious source of funding for new deals. And Peter and Jamie, when we talk about the holdings, maybe we can talk about how you guys have reallocated some money and creating a profile that's created the sort of dynamism that we have seen.
Yeah,
And
that's a good point because we're definitely not wed to these positions, and we end up with very large holdings. But if you go back and look through our holdings in the past, these were not the names that were at the top, and we have gotten to the point where we see whether it's most of the time it becomes valuation risk in a name, and we've sold 10% positions. So
yeah.
that's the other side of adding alpha. You look at the performance of the top holdings is one thing, but what you sell is just as important.
So here we see the performance versus some indices, the benchmark, and the peers that we monitor. The dark shading is outperformance, the white shading is underperformance. On the 10-year basis, that obviously includes we've managed this fund since April 2019. The 10-year obviously includes a period from before that as well. You see numerous periods of outperformance. The period where it underperformed was in 2022, notably. That was the quote unquote higher for longer environment that also spilled into 2023. And basically, when you invest in these junior mining companies, They do have funding risk, and it's not identical to credit risk, but very closely correlated. That in that sort of environment where the funding environment is tough, the valuations tend to be lower. Now, the flip side of that is that has brought tremendous opportunities as well. We were not staying on the sidelines, but repositioning the portfolio for that period of growth we have seen since then. And so that while we couldn't avoid the downturn with the sort of portfolio structure that we have, we were able to position the fund to take advantage of the to fully take advantage of the boom that we're experiencing right now. And so, and for what it's worth, the mining sector has the greatest dispersion of returns in amongst the S&P sectors, which is a fancy way of saying that active management truly matters. And part of it is because the mines get depleted just so quickly. You need to once you have an operating mine, you need to constantly find new mines, and we let the existing management team do that because ultimately it's the management team we invest in. Sometimes we talk about that we have a venture capital light approach, and anyone who's kind of watched venture capital companies, anybody who has previously executed well on a project is much more likely to raise money than unproven teams, even if they have a quote unquote brilliant idea. And the same thing happens in other industries, and specifically also here where we are. And so with that, let me pass it on here to Peter to talk about some specifics in the portfolio. We publish this on a monthly basis with some delay, but Peter and then Jamie as well, maybe talk a little bit about kind of the approach that we have, maybe some specifics. We don't give any specific recommendation on any one security, and very much discourage anyone to just copying the portfolio that we do. You don't know when we are adding or taking away from a position or what exactly the rationale is why we have a position. But Peter, go ahead.
Yeah, I think kind of the recent history. One of the things, one of the tables that I like to look at right now is the type of mining. It's the second table there, and it shows that mining companies are 59% of NAV. And I think, the performance table on the previous slide is something we looked at. When we first started managing the portfolio, we invested in a combination of development companies and exploration companies, and a lot of those exploration and more specifically the development companies have become producing companies in that time frame. And so while in prior, in years past, the development companies would be a much larger percentage of NAV. Now, while it shows that it's only 7 to 8% of the portfolio, I would argue that a significant portion of those mining companies are still development companies. They have either ramping up specific mines that they've built, or they have mines that they're building that are ramping up in conjunction with production that they already have. So a lot of these mining companies really the growth is still there. The execution of new builds is part of the risk, but also the significant reward. And these companies are growing, so we're not just focusing on cash flow generation. It's always good to have, but there also a lot of them have use of those cash flows to build mines. Where in the prior 3 to 4 years ago, a lot of these companies were relying solely on the capital markets to fund their growth projects. Where some of the companies that we've owned and grew with have bought producing assets and developed producing assets that are funding the future growth. So the capital markets aren't as important for these companies moving forward. We do have a high concentration at the top end of the portfolio, and all these are companies that we've owned from the start, and they've just grown into that size. We don't take 5 or 6% positions right away. They usually are 2 to 3%, and then they grow. And in the case of G Mining, as most people that have been a part of our webinars, this is a company that we had one of the best build teams decide to go out on their own and build a company. And it took a while. We funded them before they even had an asset, and they found an asset in Brazil, and it's up and running right now. Since then, they've bought an asset in Guyana that they're in the process of building, getting permits. And we feel that this is the type of team you want to back as they are growing their business. America's Gold and Silver is a relatively new position, I'd say, about a year and a half old. It's a name that we found a management team that we've known for years at other companies, and they found an unloved asset that was probably maybe mismanaged, and they've come in and they've kind of righted the ship. And so they're building a North American-based producer of silver with some antimony sort of backing it. Orla Mining was what I always like to say was the very first new position we put in when we started managing the fund in 2019. And this is a company that had bought an asset in Mexico, and we've seen it grow from being an exploration, then to a development company, then to a producer. And in the recent year, they bought an asset off of Newmont to expand their production up in Canada. So moving away, not solely relying on Mexico as their primary production. They also bought a project in Nevada that's going to start ramping up here in the next 2 to 3 years. So they have this internal growth, optimization of an older mine, where it's generating significant cash flow to be able to fund their development going forward. Another thing we also kind of look at is we're looking at groups that can get backing. We can fund them to a point, and as the fund gets bigger, it makes it a little easier. But also need to make sure that in a funding environment, there are groups that are supporting it through thick and thin. And we have a lot of partnerships with groups that have deeper pockets than us that want to take it to the next level. These companies necessarily would not get investments from these groups early on because it's too small a project. But as it grows, they get larger institutional base and also private investors that can fund things to the next level, and that's what we like.
I guess also to comment on is just the diversity of assets that we can hold that we can hold very liquid shell companies at the beginning, and we can hold private companies which have been pretty successful for us, and I'd say that that's a differentiator between some of the other funds. So like San Cristobal, which is a large holding now, is a private company that's that has it's a large silver producer, and it's produced very strong cash flow. So that's been a good contributor. And then also we have Southwest Critical Minerals. We've done a deal with another private equity group and own a stake in the a Nevada-based copper play. So yeah, that's something that you won't find in other portfolios.
Peter, do you want to just expand a little bit on how we sometimes take money from our successful investments to fund smaller ones?
Sure. With a lot of these companies, at the top end, we've sold some of the shares along the way as they become large positions. We're very comfortable with the size of these positions as they are right now because we believe in the management teams. But we sell, along the way to reallocate to the next up and coming companies and management teams. I'd say there's been names that we got in very early, and some of them became, between 5 and 10% positions. And they kind of reached that point where we didn't feel comfortable with the growth profile or just felt that there was better opportunities elsewhere. And we've sold out of some of these positions entirely and reallocated into names like, America's Gold and Silver is a good example of a reallocation that was, good timing, but also fundamentally based.
Good. And then I believe the question had come in on some owners reducing their stake in Orla, and also Orla reminds me of Mexican permitting. Do you want to just comment on those two items?
Orla still remains one of our favorite companies. In the last 6 months, two large shareholders have sold large blocks, taking advantage of the market we're in. But these are companies, Agnico and Newmont, which had stakes. Newmont vended in an asset into Orla to begin with, and they realized that they could get out of the position at a time when things were rallying. But it wasn't strategic to them. They weren't going to take it out. They were happy shareholders. And so that's how they exited. But the beauty of that was that it came at a time when the market demand is there for Orla, and some of the larger institutional investors wanted to get positions that they had been unable to get into earlier because the size of the company and the float was not significant. And so these were just strategic companies that were not going to take out Orla. Orla's become a great standalone company on their own. And so they decided that they would get out, but it was filled very quickly by high quality institutional investors, and they have significant support. So it's hard to look at that as a negative. It's more of a positive that these companies succeeded so well that these two strategic larger companies were able to get out of these assets. In the
Yeah, and
case,
just to add to that, I mean, Agnico clearly said that, we're not in the business of managing equities, and so they knew they weren't going to take it out, so they sold it, but they've actually reallocated that money into other names that are within the group of companies that Orla is part of as from a greater backing standpoint. So there's some earlier stage companies that they put money into.
Yeah, no, I agree.
Yeah.
Oh, and sorry, the one other thing I'd add is the permitting. Mexico had a change in government about a year ago, and there had been a mining permit sort of ban, I guess, for open pit mining. Uh, we've seen in the last week and a half a one of the first open pit permits being submitted, and that has been approved, and that has given a lot of companies hope that there should be some more permits that are approved in the future. And Orla, with their Camino Rojo mine in Mexico, has had some permitting risk because the permit has not been approved. But we are hopeful and expect that this permit should come in the near future.
Yeah, and as we understand that the Mexican government has a huge inventory of projects to go through, and they're stuck in a bureaucratic malaise with having had their sermon at their department has been reduced in staff during the last administration, and they're having to ramp back up and sort to go through all these projects. And it's not just mining projects; it's like quarries and roads and other things like that. So they have this big backlog of projects that they're working through.
And then just one other comment on the portfolios that we always talk about how we get in early with new projects. There's a couple of examples in the portfolio. Fuerte Metals and Carchetti are examples of relationships we develop with groups that have been able to take assets from the majors that were non-core and be able to inject some capital, and we'll hopefully get the development or optimization done. Forte bought an asset from Newmont called Coffee that we has deep backers, and the development of that project is very exciting to us. Carchetti is an asset that a team that we have backed in the past got an asset out of Barrick up in Canada. Both these are up in Canada, and so this is in the early stages of kind of the re-rate that we expect from these types of companies.
Yeah, also Fuerte is one of the ones that publicly Agnico became a shareholder of.
Correct.
Yeah.
Yep.
Let me pass it on to Darshan to manage the Q&A here.
Thank you, Axel. Yes, the first question, do you have a minimum market cap threshold for a district scale exploration deal?
So I would say as the fund gets bigger, we have to look at the risk reward and the size of an investment to determine whether an investment makes sense. So the size of the investment has in our kind of not specifically has probably increased, but if we can get an early stage entry to a company for exploration, we'll do it. But again, we can invest around multiple companies in sort of that venture capital approach in some of
Yeah.
these smaller names.
I guess to talk about that in a different way is that sometimes in several cases, we just align ourselves with teams that we like, and we actually invest in a shell, which is a company that doesn't have any projects, and we're just funding a team to go search. Maybe and it's a certain region, maybe it's a certain deposit type, maybe it's a specific, stage of development that they're looking for, and allow them to scour the earth to find a deposit and then back them as they go forward. But those investments can sometimes be tiny. I mean, they might be, $1 million or something like that. So, yeah.
And
Uh,
we're doing that not only in Canada, North America, but also Australia. We have relationships with groups that we trust very explicitly that they are some of the best at finding these unloved assets and getting that investment to fruition.
And
and
to
it might
just
seem insignificant to have, a $500,000 investment in $1 billion fund. But it's oftentimes those early investments when you're backing these teams where you see like 20x returns. So that's the reason for doing it.
and often
And
just from a
also
compliance hat, that
Yeah.
of course is no assurance
No
that will
assurance, but
happen.
like that,
Yeah,
you're
but
not going to see, you're likely not going to see
yeah,
a 20x return
and
investing in a $20
and
billion
yeah,
company,
and just to
Yeah.
clarify, these companies tend to be incorporated in Canada and Australia. One of the
Yeah.
questions that I've seen is where we invest, and so that can be globally. But Peter, if you want to expand on that.
yeah, well, I'd also just was going to add that we talk about the long tail of our portfolio and the beauty of the closed-end structure is that we don't have to sell anything if necessary. And so an example is a company called TDG. We invested in a number of years ago. They had an exploration play. It's in a region that we like up in the Yukon, or I'm sorry, British Columbia, and they kind of fell apart. It was the stock just kind of didn't do anything. Two other groups nearby merged to create a larger development story. But then in the last, year and a half, they found an exploration play on their asset where Freeport invested in another company and was drilling right on their border. And it appears that they found something different than what we were originally looking at. And sometimes you get these re-rates where a company goes from kind of nothing back into an exciting new company to invest in.
And next question is, what geographies will you or won't you invest in?
Um, we are less geopolitically concerned. We're more focused on management and assets. That being said, every time we look at investment, we have to evaluate the region that they're in. 2 years ago, West Africa was one of the best places to go. It was one of the easiest places to find a mine and build it in timeline. It's gotten very challenging. 2 years ago, Latin America was a hard place to invest in. That's flip-flopped in the last 2 years.
Yeah.
Um, so we have to look at a country by basis. Even within the country, you have to figure out if it's the right region. So it's part of the analysis, but we don't say no to anything other than maybe say China and Russia and some of those areas where you just know you're not going to get good government relationships.
Yeah, adding to that too is it's looking at the value and price that you're paying for things in different regions, and certainly the market prices things different in different regions. And so that is something we look into, and you're the price that you're getting in, but then the potential price that in multiple that stock could attain in that region is also a determinant. But example, some of these regions do take a huge amount of the proceeds from the mines, but they're still can be very cash generative. For example, in Bolivia, I think the current tax regime ends up taking like 70% of the value of the what comes out of the earth. But that being said, we've found investments that have generated a lot of cash in that region. So
Yeah.
yeah,
And what I mentioned that West Africa is a challenging jurisdiction, but one of our favored investments and bigger investments is um, uh,
in Guinea,
Robex and
yeah,
Guinea. Yeah, and so
yeah.
we're very comfortable with that country specifically.
And the management team who's kind of orchestrating that and dealing with the political relations.
Yep.
And you have Rio Tinto that's investing, whatever it is, like $30 billion into the country as
Mhm.
well.
Mhm.
Yeah, next question. What is the evidence to suggest the big gold miners will start to take over explorers with promising results?
That's it's been part of our thesis in the past that greenfield exploration, which is new exploration, has been, kind of the large companies have stopped doing that. Um, I would say that, and they've kind of offloaded that to some of the junior exploration companies. And so those companies go out and fund the drilling, find these assets, kind of start the generative kind of theories around where they're looking. And, sometimes the large companies will fund these companies that as a strategic investor, they'll give their teams over, to sort of have discussions and analyze the drilling that they do. So the larger companies, as they get bigger, exploration becomes less of a focus, and they're looking more at if they're going to do anything with growth, it's more likely going to be M&A of a larger development story or a farther along exploration play. And so we're seeing some of that, but I would say that, yeah, exploration, they're going to fund it and wait for a lot of the de-risking to happen because they don't need to do a lot of that, and they find that the juniors are a lot more nimble at doing that rather than having a large company go and do it.
I think to add on to that as well is that the large miners, specifically Newmont and Barrick and even Anglo Gold and Goldfields, Newmont produces whatever 7 million ounces a year. And in order to replace those ounces is very difficult. In fact, they have a very flat production profile going forward. And there just aren't exploration plays and discoveries that would make a dent in their production profile. So they're stuck with like looking at probably taking over mid-tier miners, or as Peter said, alluded to, is merging with other large companies, which oftentimes we don't think creates any value. And that's part of the reason that we are focused on these companies that can kind of grow into mid-cap companies that end up producing between 500,000 to 1.5 million ounces. We just think that that's a much better place to be in the sector because the way that the world has been endowed with gold in the ground, that's a size at which you can continue to grow your asset base and replace your reserves. Once you get up to 7 million ounces, you're really stuck on a treadmill. And that's why those companies have genuinely been focused on going and looking at copper assets, which tend to be larger and have more mine life, but they also have these enormous capex numbers in front of them. So we just think that there's a lot more value in the mid cap space.
And just to take it like one step further is um, we see that there's a better chance of positive M&A on the smaller cap size as you put together companies that are synergistic or have the ability to show growth where funding for development of a project is less of a risk. And then
An example
another,
of that is just that we saw a merger between two of our companies, between Robex and Predictive, which actually had neighboring properties where, there's certainly synergies for shared infrastructure and personnel. And yeah, I think that's a big win for them.
yeah, and then another additive thing to that is that these small companies, as they get larger, get added to numerous within their region and globally, which gives you another re-rate as the ETFs still are a popular way of investing in the space.
The passive
Yeah.
money train.
Yeah.
Yeah, so last question. How important is President Trump's new mining policy for accelerating precious metals development in the US?
I can
Sorry,
take that. I mean,
yeah, why
I
don't you take
think,
that?
yeah, it's just, I mean, to be determined. It's all pointing in the right direction, and it should be very constructive for moving these projects along. But oh, yeah, we'll believe it when we see it. We've seen some very positive movement forward, like for example, on the Stibnite project in Idaho, and certainly the government's willingness to invest within the equity of the companies is certainly providing a tailwind. We haven't seen any direct investments in a gold-only project. I mean, to be honest, the Perpetua Stibnite project is I think 90% of the economics are gold, if not more. But the government invested in it due to the antimony credit. Yeah, so we see it as a definite positive, but I'd like to see it play out first with a couple more assets and seeing some permits. That would be great.
All right. Well, thank you, everybody. There were several other questions that we didn't get to. We'll try to get to you individually. Darshan, if you want to wrap it up.